trying to nail down what the specifics of trade are at any specific point in time when there are so many moving pieces is extraordinarily difficult. I think the big fundamental overriding problem with regard to trade is the fact that both parties, Xi and Trump, need to come away from this looking like they've gained something. And that's the problem for the two of them, because neither of them are willing to bend towards the other. And the net result is I think we're likely to go back and forth with these kind of situations for quite some time until it becomes very apparent to the two of them they've just got to accept a simple agriculture trade bill and get it done with. And that's the first phase.
You know, Scott, the president yesterday said that the Chinese are dying for a deal, and it's basically our decision as to whether we want one. It looks to me like the market is dying for a deal one way or another.
Well, Ty, I think the market is pricing in at least some kind of minor deal, and I think that's probably the way to do it. But, you know, critical to the whole process is going to be, you know, if these December tariffs go in, then, you know, the market's not going to like that. So I think that on a day-to-day basis, we hear, you know, they're going good, they're going bad, those types of things. But the market's going to be sensitive to that. But at least in our minds, clearly the market's leaning towards some kind of a minor deal. The market does not need some comprehensive deal or anything like that. But ideally, you know, you'd roll off these September tariffs that are already in place, and then you wouldn't do the Decembers. And I think that'd be the best outcome that the market could want.
Got it.
It would be, but the headlines seem a little bit more intense as the days go on. So, Steve, I guess the question to you is, you know, we heard from Chair Powell, as Steve Leisman had outlined earlier, and it seemed like there wouldn't be any deviation from the course in terms of cutting rates or moving rates whatsoever if the December 15th tariffs go into effect on top of the tariffs that are already into effect. Do you think that the Fed would move, not necessarily in December, but maybe early next year?
Well, let's understand from base number one, the Fed's short-term interest rate levels are too high. The dollar is rising, and that is a problem. We run the risk of importing global deflationary risks. That's why companies don't have pricing power. That's why companies continue to shift costs, like we saw in the CPI today, where they're shifting costs from corporate expenses to consumer expenses through healthcare, because they've got to keep earnings up in an environment without pricing power. Because we're importing deflation, that's a problem. The Fed has to realize its biggest problem is global deflation risk, not domestic macroeconomic conditions. They're not there yet. I think within the next several months, they'll be there.
And how will they manifest that?
They'll have to cut interest rates. I mean, interest rates are going to have to go down. I think they're going to have to move their balance sheet from just buying bills to buying out the short coupons. They've got to steepen the curve, and they've got to steepen the curve from the 2-year out to the 10-year, and they probably have to flatten the Fed funds rate to the 2-year note substantially in order to drive home to foreign investors the fact that you're not going to be able to double down by borrowing at negative rates overseas, putting it to work at positive returns here, and getting a positive currency in the middle. The dollar has to go lower. We've moved up above 98 on a DXY weight basis, which is basically a dollar traded weighted basket. And I think that's a critical level. When we got to 99.5, the Fed balked and they started buying bills. I think we're going to go back there and they'll begin to buy coupons.
Steve, this is what you believe, though, aside from tariffs going into effect, right?
That is correct.
Yeah.